I am Stephanie San Antonio, President and CEO of SSA Insurance Services. And for some of you that are on the call who are financial advisors and really work with Tom and Waiting Room and Dur and his company, they help design retirement plans. And then you guys help, for those that are on the call that are financial advisors, help obviously support your clients in executing and managing their retirement plans. What we do on the benefit side is we are specialists. We help with the plan design. We help companies design and implement their benefits. So we're doing kind of both the financial advisor side and the plan design side when it comes to employee benefits, medical, dental, vision, right? All the kind of the health lines of coverage. So our clients are anywhere from, the startup business, which I love designing a startup plan. We also really come into play when companies are at that 20, 25, 30 employee count where their current benefits plan isn't quite cutting it for them, and will typically be referred in because this is when employers need to hire the higher level talent and they need to really kind of build out their benefits package a little bit richer. And this is also the time we see people engaging when wanting to bring in a retirement plan as well. So that's a little bit about us. We have a team of 7 employees, and we do a great job. Our goal is the concierge service with a human touch and a smile, and making sure our clients have a positive experience when onboarding, and also making sure our clients, business owners, look good at doing it and that they stand out. So that's a little bit about SSA. Thank you guys for being on the call today. It is a mix of kind of Tom's contacts as well as our clients. And we are here today to talk about 2021 retirement plan trends for businesses. And I want to do a little introduction to Tom before I let him continue his introduction. So Tom and I met years ago. Gosh, I have to say, Tom, 10, 12
Yeah,
years
you were like
ago.
12. I think you were like 12.
I feel like I was a baby, and now I'm, the wrinkles are definitely setting in. And so Tom was he's always been so connected in San Diego. I'm sure even my clients that are on this call are, or probably your clients as well.
There's a lot of mutual ones, coincidentally, yeah.
And so we're honored to have you on today, Tom, to share with us your insight. Tom started Premier Plan Consultants with the belief that having a company retirement plan should be a rewarding benefit for business owners and their employees. The mission is to help employers with smart plan design by aligning and maximizing workplace and employee retirement plan goals. He has over 18 years of experience. He's worked with over 2,000 companies. And they know what they're doing. They do it well. He is the TPA for our retirement plan that we've established this year. And we're just really excited that you're on this call. So thanks for joining us, and I'll let you take it away.
Wonderful. Well, thank you very much. I'm going to go ahead and pull up my PowerPoint. If we can do this right, see if this works. User error. There we go. Okay, cool. So thank you very much for having us. Thank all of you guys for joining. Yeah, a ton of familiar faces. It's kind of funny how small this world gets. And started looking at the list, and Stefan was like, "Oh, you know these folks?" And I'm like, "Oh, these are our client." And that's so we just haphazardly crossed over with a lot of mutual clients. And so truly appreciate you guys taking the time to join us today. We got this set for an hour. My goal here is to maybe have a half an hour to 20 minutes of content and tackle a few things. And then kind of leave it open probably in between each section for a little bit of Q&A. And then also kind of at the end, either wrap up early or some questions on that front. So for those of you that I may not know very well, I'm going to spare everyone a massive commercial, but I would like to kind of give a little bit of background on our organization, because that'll set context to the conversation that we're going to have today. So Premier Plan Consultants, we've actually, myself and Stacy, who's on the line, and Bobby, who's with us, we started this business in 2017. So we're just over 4 years old. We have all been in the biz for over 20 years. So we've been in this business for a long time, but we saw a space where a lot of businesses like ours were being acquired by large national firms. And we felt there was a space for a local firm to come back in and really provide that higher level of customer service, much like Stephanie was mentioning for her group. So we spun out of an old company that was acquired by a private equity firm. And we started this, like I said, just over 4 years ago. I always laugh because everyone's like, oh, it's around year 3 where it makes sense. Well, year 3 for us was the day we sent everyone home for COVID. So that added a little wrinkle into things. But it actually proved to be, I'm going to kind of talk about trends and things that we've seen. And, oddly, last year in our space ended up being remarkably busy. Little odd in the middle of last year, but as we hit last year and this year, we've been as busy as we've ever been, and we've grown quite a bit. So as we sit here today, we work with about 1,200 local businesses. So I've got a staff of going on 25, and we work with about 1,200 local businesses. Those range in size from, one-person tax planning strategies up to, we have a few clients in the multiple thousands of employees. That's a big, broad range. So if we were to narrow that down a little bit to what's typical, our typical client is probably 10 employees to 100 employees, closely held, local, kind of not coincidental that it's not coincidental that it's kind of the average San Diego employer, right? I mean, most companies in San Diego have 25, 30 people. That's really who we come in and help. And really what our role is we help on the plan design, compliance, tax filing. Think of us like an extension of HR and an extension of finance. So we're usually going into entities that are, a little bit smaller, may not have a 401k specialist or anyone in-house, and really need someone as, a hand to hold along the way as it relates to all the nuances of 401k options, retirement plan options. What should we be doing? What are other companies doing, those kind of things. So that's really the types of groups we can help, is those mid-sized companies that are trying to put together competitive benefits, want to do the right thing for the company, want to do the right thing for the employees, and just need a little hand holding, putting it all together. Okay. So what I'm going to do is kind of break this into a couple sections from the invite. First thing I want to tackle is CalSavers. Let me actually see if I can get to our agenda here. Give me a sec. That's weird. Okay. I want to tackle CalSavers. Okay. California is one of 8 states that is rolling out a mandated retirement program for employers. So I'm going to get into the details of this. When at the end of last year, when I was giving this presentation, there were 6 states that had it. So more and more states are getting on board with mandated retirement plans. Obviously, a good number of you on this call are clients or will be here maybe by the end of the day, Mary Jo. So you're already moving down the path of having your own plan. But I also think it's a good thing to be thinking about, because as businesses change, as you might buy an entity or do different things and want to look at your retirement, you need to know what the state's going to be requiring. So even if you have a plan today, this is going to be a good little bit of information to have. As I mentioned, the focus of our business is really those mid-sized business 401k plans. So I'm going to spend a little bit of time talking about trends and what we're seeing in that space. And then on the back end of this, I want to tackle tax planning strategies. When the country goes out and spends umpteen $1 trillion over the last 12 to 18 months, one of the things that's going to come out of that is taxes will be going up. And so there are some neat tax planning strategies as small businesses that sometimes we're just not aware of. Okay, a lot of companies think that the limits that people can save are either the 19.5 or the 26 in the 401k side of things, or maybe if we get into profit sharing, we can save as much as high 50s, low 60s. The reality is there's other plans out there where you can get into the hundreds of thousands of dollars that can be put away on a tax advantage basis. So I'm going to kind of wrap up with that. With that, I'm going to jump into CalSavers. Okay. So CalSavers was signed into law in 2016. Okay. It was fondly referred to as SB 1234, really creative name for what it was in the early days. As it migrated, as it came to fruition, it is now referred to as CalSavers. I'm going to send out a piece on this to go along with this, which will have the link to the website and everything else. But at the time this was signed into law, 7 million California employees didn't have access to any type of business retirement plan, or so they didn't have an ability to save other than to do IRAs on their own. So the goal of CalSavers was to provide employers in California a cost-efficient way to help their employees save for retirement. Okay. Now, I've met with the CalSavers rep a few times at this point. Ultimately, what CalSavers is trying to do is really encourage people to either set up their own retirement plan, like get something in place to engage your people, or have this as a low cost option. Okay. And I'm going to define low cost as I go through this a little bit better, because the reality is there is no charge to employers to be a part of CalSavers. You don't have to pay the state of California any fee to be a part of CalSavers. But I would suggest there could be, depending on the size of your organization, cost comes in different flavors, right? One is checks we write as business owners. The other thing is operational overhead. And there's probably going to be some operational overhead for a lot of businesses that are a part of CalSavers that may want you to encourage you to revisit other options. Okay. So I think at the end of the day, it is a well-intentioned program. When we have that many people that aren't saving, and to take that a step further, there's got some financial folks on the group here today. When we go look at what I would call a rich retirement plan, one that's got a lot of money in it, your typical average, like a high balance plan, is $100,000. Okay. Most people save the vast majority of what they're going to have in retirement in their business retirement plan. So that's kind of an interesting, if not scary, thing to unpack a little bit, is that if most people save everything in their retirement plan, and the plans that have the richest average account balance are somewhere in that $100,000 range, that tells us and some people carry the bulk of those balances, right? So that's really the saving state of most of the companies in our country, for that matter, in our state for sure, and our country above and beyond that. So we all need to save more, the intention as well. The challenge is going to be, and I'm going to get into this in a little bit more detail, it is an automatic enrollment Roth IRA. So a Roth IRA, we do not get the tax break today. But we get to take the money out tax free. So we get money put away, we get to take that money out tax free for retirement. The thing I'm going to dig into a little bit is this auto enrollment feature, because that's when we start talking about costs and operational overhead. That's the thing you want to be looking at. Okay. Sorry, I'm going to move my camera around a little bit. So what is CalSavers? I say that it is a newish mandate, newish being that it was signed into law in 2016, and it's being rolled out over 3 years. And I'm going to put the deadlines on it. I've got the deadlines and timelines on the next slide. But basically, it started in 2020 for employers to comply, and then it'll go all the way through June of 2022. So by the end of 2020, by June of 2022, if you have over 5 employees in the state of California, you're either going to need to have your own retirement plan, or you're going to need to engage in CalSavers. I did highlight employers that do not offer a plan. So if you're an employer in California and you offer some type of business retirement plan, in a nonprofit, that can be a 403B. In a for-profit, that's a 401k, profit sharing, SEP IRA, simple IRA, defined benefit plan. As long as you have some type of business retirement plan, you get to opt out of CalSavers. Okay. The key to that is you have to opt out. Okay. You don't automatically, and I have a piece we'll send out that shows you how to opt out, but it's not automatic. You do need to tell the state that you exist, and you do need to tell the state that you have a plan and you're electing to not be a part of CalSavers. Okay. If you do not offer a plan and you meet these following requirements, you're going to need to do a little digging. So number one is, do you have no more than 5 employees? Okay. Are those employees 18 years of age or older? And have they completed 30 days of service? Okay. So I have a client who's been my client for years and years and years. And she runs the kayak businesses in La Jolla, Coronado, all of those. Well, she staffs a ton of people for a very short period of time, 3 to 6 months over the summer. And those are college kids. Everybody comes. So they're over the age of 18. They've been there 30 days. And there's a lot of them, and they come and go. So those are the types of businesses where this is going to be a challenge, because those are part-time folks working for summer money, saving for college. But those businesses, if she didn't have a retirement plan, because we were actually thinking about winding it down over the last couple of years, they have to comply. So when you think about that, and restaurants, janitorial business, just heavy service-based businesses, those are the ones where you can have a lot of coming and going. You want to be really thoughtful about the structure of those and how you do it, and whether CalSavers is going to be a fit for you. Okay. So here's how it works. Again, this is really high level to get some major concepts across. Number one, it's an automatic enrollment Roth IRA. So employees are need to be opted in automatic. Okay. And I should probably take a step backwards. When I refer to automatic, this means it's automatic for the employee. Okay. That doesn't necessarily mean it's automatic for the employer. So the employer is going to have to track this, work with payroll companies and everything else to do this. So number one, it's an automatic enrollment Roth IRA. Number two, employees must be auto-enrolled at 5% of pay. So it starts at 5%. Second piece to this is you got to do an annual increase of 1% a year until employees hit 8% a year. Now, it's not a required contribution, it's an automatic one. So employees can opt out. So they can say, hey, I know you're offering to me, I know I'm supposed to be doing this, I prefer not to. So employees can opt out. You have to keep that in writing. And then every 2 years, you have to go back and either re-auto enroll those employees or they have to opt out again. So that, when we start looking at the tracking, if you only have a few people, and you're not ready to jump on the retirement plan, formal retirement plan bus, this might be a good fit. But when you start getting into lots of people and coming and going and auto enrollment and different income ranges and having to track opt-outs, there's going to be some companies that you will be way better off setting up a plan, paying the necessary fees to run a plan, just to not have to engage in this program. And again, it comes back to one of the goals of this program is to provide cost-efficient retirement plans for employers. So CalSavers, they just want employers doing something. And something might be CalSavers, something might be encouraging you to jump on the retirement plan bus a little bit sooner than you may have otherwise. Okay. A couple things that are different about CalSavers than like true business retirement plans, because CalSavers is being run by the state. 401ks, profit sharing, those are all federally mandated. And this becomes important if you're working with restaurants, those kind of things. It's at the entity level. So the way CalSavers is going to track this, the way the state's going to track it, is they look at the DE9, which is your quarterly wage report, at the entity level. So unlike a 401k plan, if you own multiple companies, we have to aggregate those for retirement plan purposes. CalSavers is going to be looked at an entity level. So if you own restaurants and each restaurant is its own entity, business entity, you might have 100 employees in total, but if you only have 10 to 30 in any given group, then you won't be getting the love letters yet, but you will be getting them eventually once we get to either the plus 50 group or the plus 5 group. There's some meat in the penalty side of this. Okay. So as I mentioned, this is getting rolled out over 3 years. The first group was 100 plus. Quite frankly, that was the challenging group because most people who have over 100 employees didn't have a plan because they didn't want one, right? We did, like I said, I had some large janitorial chains and just big restaurant chains and folks that did it to comply, did a retirement plan to not have to do CalSavers. My friend with the kayak biz kept hers because of this, but they really didn't have one because they weren't going to get tons of participation. So that originally was June 30th of last year and got pushed to September 30th due to COVID. So they got a little bit of leeway on it, timing wise. But if you have over 100 employees, you should have either have a plan or be signed up in CalSavers as we speak. It's in here today. Okay. The penalty for not registering, it's $250 per employee. Okay. If you get the love letter, It's $250. And I haven't seen the love letter yet from it on any plans, which is interesting because we're past these deadlines. But it's $250 per employee. And then that's going to go up by $500 for if you don't do it within 6 months. So when you start looking at that, if you have 100 employees, it starts at 25,000 and goes to 75,000. That's going to get people's attention when those start going out. And so just be aware that it's out there. We're past the first deadline. The reason this is kind of a hot topic right now is because I think a lot of companies are going to fall into this window, which is the, the 50 to 100. Those are companies that are generally going to want to plan, or would generally be doing it otherwise. This might just encourage us to move a little bit quicker when it comes time. When we're setting up entities, when we're reviewing what our benefit structure is, we can start really having a thoughtful conversation. Okay, do we want to start a retirement plan now, or do we want to roll into CalSavers? So with that, I'm going to take a little break here. Questions about this? Any questions? I'll leave some time at the end, but I don't know before we move, because I'm going to change gears into plan design. So
I have a couple of questions, and if anybody wants to put the questions in the chat, I can be the moderator for those questions. That might be easier. So definitely put your questions there. A couple questions I have is like, which companies do you see that CalSavers may be a good fit for, or are you like, there's nobody, it's better to have a retirement plan that you set up yourself?
I think when we get into the 50 plus and the 5 plus, particularly the 5 and up, you may just not, if you're getting started, not that retirement plans cost a fortune, but administration on could be $3,000 or $4,000 a year. If you're going to be matching, that can add up pretty quickly, right? So if you're not quite ready for that, it might be a good fit. If we're just getting off the ground, we're not ready to kind of commit to administration fees and those, it might be a good fit for those. But I think that's really going to be more in that 5 to 50 group, right? Once you have 50 plus employees, and I'm going to get into some of when I kind of go to the next step, you're just not being competitive with your benefits if you don't have some type of legitimate retirement plan. So I think when we get into the smaller groups, CalSavers might be a real good option. I think if we're over 100, operationally, it can be a headache. And when you go 50 to 100, you should probably have some type of retirement plan. I think the 5 to 50 group, there's going to be somewhere it's easy, it's less expensive, and it's not that much overhead. So it's probably a way to do it.
And so with the 5 plus, well, with CalSavers, you as a company do not have to make a match or make a contribution.
There are no company contributions. No company contributions are allowed. Okay. That's correct.
Oh, there's no employer contributions are allowed at all.
Correct. Just employee money, and you're subject to the Roth IRA limit. So whatever the Roth IRA limit in any given year, that's your limit.
Got it. And what you're saying is for the companies that probably already set something up outside of CalSavers, it's the high turnover companies where even though it's free, the company doesn't have to make a contribution. The deal is they probably will have increased payroll fees because now they have to tie into CalSavers, and after 30 days, somebody's eligible. Whereas if you set up your own retirement plan, you can make the eligibility much longer, right? And then you're not having to deal with
for some of these bigger groups, we just did really long eligibility, like a 1 year, and said, okay, we'll do a 1 year wait. And then that way, all that front end, 6 months to 1 year, those front end turnover, they never become eligible. So you don't have to add them in, and it's just easier to operate. That's the same like the kayak biz. 1 year wait, we let people in twice a year. Most of those people that come and go over the summer never meet the eligibility requirement. Gotcha. The other question I get on that is if they're not, it is the existence of a business retirement plan that opts you out of CalSavers. So just because your employees aren't eligible for your retirement plan doesn't mean you have to unload them into CalSavers. Once the company has a plan, you get to play by those plan limits, and that's what takes you out of the CalSavers club, if you will.
Gotcha. And just so those on the call, the letter, I think Walter said he received the letter from the state. However, the company FIN didn't match, still waiting to opt out since they do have a retirement plan. What can I do if we do not receive the form prior to 6:30? Tom.
I haven't seen the penalty. Like I said, I haven't seen how they're going to enforce this. I think it would be hard pressed that the state's going to come back as long as you can show that we covered those entities. And Walter, that's a good point. Like if you have multiple entities, right? And you may be sponsoring it under a parent company, but some of the other entities don't necessarily have a plan. You do have to go opt out for each of the respective entities that are covered in the plan. Kind of the reverse of what I was explaining about the restaurant, where, hey, if you're not over the limit, keep in mind, if you are over the limit, but you have these smaller businesses that are participating in a larger plan, you need to go in with each entity and opt that entity and tax ID out.
Makes sense.
Yeah, Tom, real quick, Tom, what happened here was we changed our company name. It's still the same name. It's always been CTM. But when we did that, we got a new ENT, which was about 5 or 6 years ago. The information they sent us was with the OENT. So do I have to opt out of both of those, even though that company no longer exists?
I would at this point. But I also know how to find you, Walter. So maybe we kind of take that. I can kind of talk through, because I'll send you our opt-out piece, and then we can go through it and see what works on that. Some of this we're going to learn together, quite frankly. Like, this is just coming. The sign up letters are just getting out to people. So this is going to be new, and there's going to be a little bit of a learning curve for all of us as far as how do you navigate, because that's a perfect example of the weird stuff that can occur.
Okay, yeah, we can talk offline. It was just
Yeah.
kind of weird because I did send in for the new ENT and still waiting on them. You know how long the state takes.
Yeah, it used to move kind of quick, like you'd send it off and then you'd get the notice. I think as more and more companies are engaging in the website, it's taken a little bit longer for sure.
Awesome.
Okay,
And then
yeah, we can
one
talk
more-
offline.
One
Yeah.
more question, Andrea asked them, do they have to opt out again every 2 years? So,
No, the company does not. The opt out, good question. When I was talking, the employees have to, if the company is a part of CalSavers, the employees within that entity have to opt out. But the company itself, once you opt out, you're out. So I encourage even if you're less than the limits, like we have 25 people, we've already opted out. And Steph, I just sent you your stuff to opt out too, since we got yours up and going. So, and then for those of you who are clients, we are sending out our little opt out sheet before these deadlines so that everyone knows how to go in and opt out of the program.
cool, thank you.
Okay,
I think those are all the questions in this section.
cool. How we doing time wise? Want to be respectful of that. Okay. Couple quick things I want to talk about 401k plans. Okay. Things we're seeing as far as trends. So one of the things we see now, keep in mind, we tend to work with smaller businesses where, they're doing this because they're trying to attract really good talent, and they're usually willing to spend a little bit of money on their benefits to make sure that they have got a competitive offering. That's kind of my niche as far as who we can really develop cool strategies for. So a couple things on that. First and foremost, and for those of you who have safe harbor, one of the biggest challenges in small businesses is non-discrimination testing. And basically what that means is your owners and your highest paid people within your organization can sometimes be limited by what everybody else does. And, if you're a really big company, those averages work out. But as we get smaller, it can literally be the participation or lack of participation of 1 or 2 people that can throw your testing completely out of whack. And now your business owners and your key people get their money refunded to them. So, and safe harbor isn't new, these have been around forever. But basically what a safe harbor is it allows employers to say, hey, look, we're willing to make this guaranteed contribution. And by making that contribution, we don't have to do the non-discrimination testing. So everybody gets to go to the 401k limits, which is this year 19.5. If we're 50 or older, it's 26. Okay. We get to either choose, do we want to give 3% to everybody, whether they participate or not, or do we want to match people 4%? So it's a little bit more per person, but it only goes to people who put their own money into the program. And there's different reasons to go one version or the other. Here's one of the rules that just changed, and it changed last year. So there was a law that was enacted at the end of 19 called Secure Act, and it kind of got forgotten with CARES Act and COVID and everything else that came out. But one of the cool features about that was, for the 20 years I've been in this business, if you could only make the safe harbor change on an annual basis, you had to do it before the year starts. With Secure Act, companies can now enact that 3% safe harbor in the middle of a year, even if their plan is active. So if you end up in an environment where you're failing your non-discrimination testing and your best employees are getting all their money returned to them, you do have the option of turning on that safe harbor in the middle of the year, realistically all the way up to December. Then it gets a little weird after that. There's some other options after that, but that's kind of a details conversation. Key with safe harbor, it has to be 100% vested. You're putting the money in, it goes to the folks. If they leave, they get to take it all with them. Okay. One of the other things, and again, this ties back to Cal Savers. This is going to start to tie into Secure Act, what we're calling Secure Act 2.0, kind of the next version. What we're going to see at the federal level, and obviously we're already seeing it at the state level, is the engagement of employees automatically, this whole theme of automatic enrollment. So automatic enrollment 5-6 years ago, when payroll integration wasn't as robust, was probably a little bit more challenging. It's getting better now because payroll companies are talking with investment companies better. That link is a little bit tighter nowadays than it was even a few years ago. We're seeing a lot more interest in automatic enrollment 401k plans. Okay. But here's the thing I really want to look at in the conversation, when I ask people if you're serious about this. One is, do you have an executive team that fundamentally believes in engaging your employees in your business retirement plan? And the reason I bring this up is there can be a big brother aspect to automatic enrollment. Oh, well, we kind of feel like we're forcing people. Okay. As soon as I hear people at a management executive level say, hey, I feel like we're forcing people to save, that's fine. That's your business. But you're probably not a good candidate for automatic enrollment, right? You really need it to be at the management level to say, this is what we believe in. We want to get people doing it. We want them saving for retirement. And we're willing to kind of put that in our documents that says, this is what we're doing, okay? If you do have a team that believes in it and wants to do it for staff, then I kind of look at the next two things. Number one is, do you have a demographic that can support it, okay? This is one of my challenges with Cal Savers, for that matter, is we're auto enrolling probably a lot of minimum wage people in a really expensive state. You're going to get a lot of people that want to opt out. So with 401k plans, a lot of my auto enrollment plans are higher earners, biotech, those kind of things. And companies are literally just trying to make it easy for people to have money in the retirement plan. Okay. So key is, do you have a demographic that can support the process? Okay. And then the last thing I always say is, do it with impact. I'm taking over a plan right now and they have a 2% automatic enrollment. At 2%, quite frankly, you're not helping your employees engage in their retirement, and you're not helping your non-discrimination testing on your plan. Most of the auto enrollment plans that we do start between 4 and 6%, and a lot of those will also have a step up. So again, if you believe in it and you think your payroll can support it, then really get people engaged in their retirement. Start them at 5-6%. And a lot of times we'll pair that up to the match. So that if, let's say you're doing 50% up to 6, you'd auto enroll them at 6, you're matching them 3, those employees are putting away 9% of pay every year. You start to move the meter as far as being successful in retirement. So that's kind of the idea there, but it can be a good tool, but you got to really look at your group and see, is it a good fit based on your company, based on your people, based on your turnover, all those things. Okay. And the last thing I'm going to touch on really quickly is I'm seeing much more liberal, particularly in smaller groups, where the 401k, Stephanie, the question you had asked me, is really being more part of the standard benefits package. Do we have health insurance? Do you have a 401k? We're being much more liberal with our eligibility. I'm typically setting it up saying, hey, what are you doing with your health insurance? Maybe you keep your eligibility in line with your health insurance so that it's easy for the company, it's easy for the employees to understand and roll out. Okay. Same thing with vesting. As employees get younger, and we have millennial and whatever the next generation is all working now. I just hired my first person who was born in 2001. So we're getting a younger demographic as they go. When we start talking about 6-year vesting schedules, that's a long time. I think that's fair for profit sharing, but if you're going to offer matching and you want it to be a tangible benefit, I think something in the 3 to 4 year range is going to have a little bit more meaningful impact as employees decide if they want to engage in the program. I'm going to jump into the next piece, try to cover that in a couple minutes, and then I'm going to leave it open because I want to promise that we had like 15 minutes at the end to either chat.
Tom, you're muted. Sorry. I think I might have done that.
Sorry,
That was my
I hit the wrong
mistake.
button or somebody did.
I meant to
Okay.
unmute myself and I muted you. Sorry.
So I'm gonna kind of dip our toes into this concept of a cash balance plan. It comes up in a lot of my calls, and a lot of folks go, oh, well, what is this thing? And can we do it? And is it a good fit? So a couple things about these programs. So as I mentioned, a lot of companies think the maximum amounts you can put into a retirement plan is $19,500. If we add in company money, that takes us to the high 50s, low 60s, okay? Per person, per year. A cash balance plan is a type of old school defined benefit plan, kind of re-envisioned and simplified for today, okay? So it is a defined benefit plan. And the big difference is in a 401k plan, in my world, we call those defined contribution plans because the IRS defines the contribution, how much we get to put in every year. In a defined benefit plan, there is no cap on which you are legally allowed to fund and deduct into a defined benefit plan. There is a cap on how much you are able to take out at retirement, okay? How much you can take out of retirement is a function of how much you make, how long you work, and whatever formula the company puts in the document, okay? But if you really load these up, you can, per person, you can extract somewhere close to $3 million at retirement age per person, okay? So for small business owners, really trying to maximize wealth retention and tax planning, these can be pretty powerful tools. The idea is the $3 million, it'll change with as interest rates change and as limits change, that'll fluctuate a little bit, but it doesn't fluctuate on a person by person basis. So if you're starting one of these programs at 40 years old and you've got 20 plus years to get to retirement, you've got 20 plus years to put away $3 million. So you don't get to put in as much. But if we start in our 50s and 60s, that window of time between today and normal retirement is shorter. So the company has to put in more for those people. But because we're setting up a benefit in the future, the IRS wants to set up with the intent of permanency, which means it's a 5-year commitment. So what I generally tell people is you got to be prepared for a 5-year bus ride, right? You don't have to fund the same amount every year, but you do need to be prepared to have the plan, do the filing, and do the things with them, okay? This last piece to this before I look at numbers really quick is, I use the phrase substantial excess income. So these are, again, typically smaller businesses, closely held. And so what I mean by that is the company needs to have more money than they need to operate the business. And in most cases, they need to have more money than the business owners have to operate their lifestyle, right? Because if we're going to talk about putting $100,000, $200,000, $300,000 a year away, that's going to eat into both. So that people that need to be prepared to fund for a period of time at substantial levels. But here's the cool thing, and I'm gonna kind of do the highlights here. So let's say I've got a small 2 owners, 4 or 5, 4 employees. My owners are in their 40s and 50s, and the employees range from age 25 to 65. Here's their compensation. They get to do their 401k amounts over here, 26 and 19.5. They get to do a little bit of profit sharing on this side of things. And now my 55-year-old business owner gets an extra $200,000 going into their cash balance plan. And again, I do this with intention. My 45-year-old is a little bit younger. They have a longer period of time to save for retirement. So their number's a little bit lower, 145,000. So when you total it, now your typical cost, and again, when I do presentations, I build demographics that make this work well, okay? But as a rule of thumb, if you have good demographics, your cost for staff in these arrangements is going to be somewhere between 8 and 12% of pay. So in this case, we're a little south of 10% of pay. As I mentioned from the beginning, this is a wealth retention and this is a tax planning strategy, okay? So part of it is really saying, okay, if we're going to put money into this benefit, how much do my owners keep? Are they better off than doing something else? Well, in this case, again, good demographics, perfect scenario, they're keeping 95% of the money. So another way to look at that is the money that's being spent for benefits is being offset by their personal tax savings. They're putting in $440,000 this year. Their owners are keeping 421 of it. It's costing them 20 grand. They get an awesome benefit for their employees. They get a nice retention tool. They get massive wealth retention and tax planning. And, the cost of a lot of this is offset by by the tax savings to the employer. And as we start to look at what's going on in our tax environment, as when you get people in these tax brackets, taxes are going to go up. There's no way they can't. The other cool thing we're doing in these types of arrangements is we're taking the 401k amount and we're encouraging people to do Roth, because the reality is taxes are going to go up. Taxes are probably going to be up for a while. What a while is, if anyone can answer that question, that would be awesome, because that would make my life a whole lot easier. But taxing. So what we're doing is I'm really talking about kind of tax plan, kind of diversification strategy when it comes time to use the money. And we use the pension to get the current year tax deduction. And then we do this 401k amount in Roth, so that when these people hit retirement, we got two big buckets to pick from, so we can kind of mitigate where tax rates are at that point. So that's kind of the idea, is that the softball for Roth is usually the younger person in a lower income bracket. But what we really want to do in this environment is kind of marry that, because a lot of my people who can afford to do these things are already a little pre-tax heavy, but they still need the tax deductions today. So we marry the cash balance arrangement with a scenario that they can do to create some after-tax money that they get for retirement. And with that, I'm done. That was a lot to cover in.
Tom, you
What
did
I
a
was
great
hoping was
job.
20, 30 minutes. It ended up being
Thank
40.
you. You did a
So I
great job.
apologize. I hope that was good.
I have a question about the cash balance. So is the cash balance contribution a factor, or you take into consideration the age and the compensation? Or
You
what is
take
it
into
based-
account the age and compensation of the business owner, or the person you're trying to fund the most for. And then we compare that to the employee group. So you need to have, it was not coincidental that I had some 25 and 35 years on there, because that helps my non-discrimination testing pass. They work better when the business owners are the oldest people in the room with the highest income. Work really well in law firms where you got senior partners, junior partners, everybody else, because you usually have a good spread of ages down below. And to be a senior partner, you had to be there a while, right? So that's like the perfect snapshot. But we got these through all different types of clients: manufacturing companies, consulting businesses, real estate, any number of things.
So this would be in addition to maximizing the profit share. Then the next step is the cash
Yeah,
balance.
you don't have a cash balance conversation until you've started to really load up your 401k profit sharing at the $50,000, $60,000 range. Kind of say, like, people come in, oh, I need a cash balance. It'd be like, your first car is a Ferrari, right? You don't even really know how to drive it very well. You don't even know what you're getting into. Same thing. You got to get the 401k going, get some profit sharing going, get used to saving large chunks of money consistently. Then we can have that conversation.
And the cash balance, is it going directly into like the your retirement plan, like your actual 401k that you're setting up?
So it's actually a separate plan
Okay.
held in a separate account,
Okay.
and all the money for everybody is pooled. So
Okay.
like in my scenario, the owner's money gets pooled with everybody else's, and then the trustees manage the money for everybody. And then we track what everyone's owed, and we pay them out if they leave.
Gotcha.
Yep.
Okay, a couple questions from Justin on the 401k side. So confirming a vanilla 401k can convert now to safe harbor for 2021.
That is correct. Using the 3% option. So you can't change to a match, but you can, if they got a 401k and they just realize they're doing it wrong, or you come in after the fact and you're like, hey, this isn't going to work very well, you can actually add that 3% safe harbor now. And that's brand new last year.
Okay. And then does adding auto enrollment increase, there's a tax credit apparently to businesses. And if you add auto enrollment, does it increase the tax credit that's available for
Yes.
people that are just starting a plan?
Yeah, so I didn't really get into tax credits because the tax credits kind of fall into two things. And this is good to know. For startup plans, the tax credit, remember I touched on Secure Act, the tax credit for startup plans used to be $500 a year for 3 years. It's kind of noise level, right? Not anyone got super excited about that. The tax credit now with Secure Act is $250 per non-highly compensated employee, capped at $5,000 per year. Now you're also capped at half of what you spend. So not everyone's going to hit $5,000 because they're not spending 10 grand in fees. But it's substantially more. Most of the ones we're looking at today, those mid-sized companies, 15 to 35 employees, they're getting $2,000, $3,000, $4,000 tax credits per year. And you get that for the first 3 years. Now, if you want to do automatic enrollment, it adds $500 to that. And if you add auto enrollment to any plan, it adds you get $500 a year for the next 3 years. So most tax credits are to encourage employers to set up plans.
So
The
when
auto enrollment one is you actually get it if you have an active plan for the last 3 or 4 years, you get a small tax credit for adding it to a regular 401k plan.
And when did the tax credit start? So if companies did recently just start a plan.
They don't even have the new forms out that I've seen. We're checking.
It's
No,
just
it's literally 2020. The
okay.
new version of the tax credit started with 2020, and we go in and check. I haven't seen the new forms. So hopefully soon, but it's all for 2020.
Okay, got it. Cool. Good to know.
Yep.
So ask your CPA for those that started a plan.
Yep. If you started a plan, it's all brand new, and it's not for moving. I have a couple of folks on here with moving plans and other things. It's not for current plans. If you're starting a brand new plan like yours,
Yeah,
then you can get a tax credit for it.
but only 401k, not simple, not any other type
No,
of.
it's anything you're spending expenses on. The reality is the only plans you're spending admin. So it's not to offset matching and those things. It's to offset administrative expenses. It's really just going to be 401k type plans.
Awesome, cool. Are there any other questions? You can feel free to go off mute and ask Tom the last few minutes.
Easy.
I know one other question that has come up frequently is just going back to your high income earning companies. You mentioned they're shortening kind of the vesting, or they're shortening the eligibility. I mean, are companies just going in vesting right away and making the max contribution when in a 401k setting, or match? What's the highest match you have that you're seeing?
Well, I get some really weird stuff. Tag letter. That's kind of a hard one to answer. I mean, I got a group that does 100% of pay, right? Like up to whatever the limit is for some of the employees. So I get some more. So the highest is weird. Typically we're seeing somewhere between 4 and 8%, hey, we're matching 50 cents on the dollar up to 4 and 8% of pay, right? I'm dealing with a guy who manages a bunch of private jets. They do 100% up to 8% because they're trying to compete against the unions and those things for the big airlines. So we really kind of tailor it to what are you trying to achieve? And I think that's the difference, is have a thoughtful approach to what are your goals, right? A lot of times I'm going to recommend a stretch match. Don't match people 100% up to 8%. You're way better doing, 50%. It's going to cost you less. You get the same value out of it, or go 50 to 16, right? In this case, he's competing against these big, the big airline unions. And so it's a different answer. We got to do that to be competitive. So part of it is what is your, the industry doing? Part of it kind of looking at individual companies, like what's going on in your space. And the rest is, why are we doing what we're doing? Or is it tax planning? Are we chasing talent? And really putting some thought into the process, right? Why are we doing what we're doing? And I can't tell you how many plans we take over. None of that occurred, right? Why'd you do it? Oh, because Sally wanted one, right? That's not a thoughtful process. Oh, so-and-so who left, now we don't know why we have what we have. We clean that stuff up all the time. So that's one thing is really think about your employee benefits and think about it in the line of, it used to be, I always used to say, hey, it was always health insurance first and then 401k second. I do think that's still the case, but 401k is absolutely becoming more and more important. And that's why I started with Cal Savers. I said that will drive employers to do this sooner. And if you want to have competitive benefits, you got to have one to be in the game.
Awesome. Any other questions? Thank you
Yeah, I'll have
so
a
much,
question.
Tom.
Oh, yeah.
Mary Jo.
Oh, okay. So Tom, you had mentioned that on the safe harbor elections, you can do it mid-year, for example. And I'm curious, say if you do the non-elective 3%, when do you have to fund that 3% on either earnings that have already passed or just throughout the whole year? When do you fund the match?
So there's the why are we doing, there's the employee benefit piece, like why do, that is a part of that. Like when do you want the employees to see the money? But the answer to your question is tax filing deadline, including extensions. So you literally, like, we're in the thick of calculating numbers for people for 2020 right now. So you
But
don't,
can
you're
you-
not legally obligated to fund until you do your taxes.
If you know you're committed to that 3% match all year,
Along the
that not, do you just do it with every payroll? And if you
Yeah,
want
we have
them
a
to have money,
3%, we have a 3% we fund with everyone, and it's all paid up when the year's over.
is you want them to see it in their investment
them to
account
see it,
every
I want them to touch
paycheck,
it.
and
And appreciate it.
so it's kind of
Absolutely.
your choice as an employer. And can you mix and match that choice or no?
We'll talk about that when we do your design setup. I'm
Yeah.
not gonna let you do that.
Okay.
Because the other gal on here is Stacy Mumby. That's my business partner, and she would be really mad if I let you do that. So yes, we usually will pick one and we will stick with it. But then
Got
we
it.
can true up and do those things as they go. So
Uh-huh.
because she's the one who
Awesome.
has to run the team that has to run these, whatever we put together. So yes. But
Thank
yeah,
you,
we'll tackle all that
everybody.
with you.
Thank you, everybody,
Cool.
for joining us. Tom, thank you for your time. Really, really appreciate it. And to have your team on the call as well. For those of you that might have come late or missed a little bit of this, we are going to have it recorded, and we'll send a follow-up email with that recording. And Tom's also going to send his PowerPoint presentation out along with a couple of other items regarding CalSavers and how to opt out. So thank you so much for the resources, Tom. You are amazing. Thank you guys for joining the call. And save the date next month, June 15th, we're having another a webinar, and it's going to be on 2021 commercial and actually in benefits trends. So our world, employee benefits, as well as commercial insurance. So if you're a business owner, there have been some changes in commercial insurance, things that you should be aware of that maybe you weren't aware of prior to COVID. So we're going to have an interesting hour discussion on 2021 commercial and employee benefits trends. So hope you guys can join us. You'll be getting an invite for that as well. Awesome. Enjoy
Thanks,
your
thanks all for
Tuesday.
joining. Hope you got a gem or two.